Welcome to Thoughts on the Market. I'm Michael Zezas, Morgan Stanley's Global Head of Fixed Income and Thematic Research. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the impact of geopolitical events on markets. It's Wednesday, February 7th at 5 p.m. in London. Geopolitical conflicts around the globe seem to be escalating in recent weeks. Increased U.S. military involvement in the Middle East, fresh uncertainty about Ukraine's resources and its conflict with Russia, and lingering concerns about the U.S.-China relationship are in focus. And since financial markets and economies around the world have become more interconnected, it's more important than ever for investors to separate signals from noise and how these events can impact markets. So here's a few key takeaways that, in our view, do just that. First, fighting in the Red Sea may influence the supply chain, but the results are probably smaller than you'd think. Yes, there's been a more than 200% increase in the cost of freight containers moving through a channel that accounts for 12% of global trade. But the diversion of the freight traffic to longer routes around Africa really just represents a one-time lengthening of the delivery of goods to port. That's because there's an oversupply of containers that were built in response to bottlenecks created by increased demand for goods during the pandemic. So now that there's a steady flow of containers with goods in them, even if they are avoiding the Red Sea, the impact on availability of goods to consumers is manageable, with only a modest effect on inflation expected by our economists. Second, ramifications on oil prices from the Middle East conflict should continue to be modest. While it might seem nonsensical that fighting in the Middle East hasn't led to higher oil prices, that's more or less what's happened. But that's because disruptions to the flow of oil don't appear to be in the interest of any of the actors involved, as it would create political and economic risk on all sides. So, if you're concerned about movements in the price of oil as a catalyst for growth or inflation, then our team recommends looking at the traditional supply and demand drivers for oil, which appear balanced around current prices. Finally, as the U.S. election campaigns gear up, so does rhetoric around the U.S.-China economic relationship, and here we see some things worth paying attention to. Simply put, higher tariffs imposed by the U.S. are a real risk in the event that party control of the White House changes. That's the stated position of Republicans' likely candidate, former President Trump, and we see no reason to doubt that based on how the former president levied tariffs last time he was in office. As our chief Asia economist Chet Naya recently noted, such an outcome creates downside risk for the China economy at a time when downside risk is accumulating for other structural reasons. It's one reason our Asia equity strategy team continues to prefer other markets in Asia, in particular Japan. Of course, these situations and their market implications can obviously evolve quickly. We'll be paying close attention and keeping you in the loop. Thanks for listening. Subscribe to Thoughts on the Market on Apple Podcasts or wherever you listen, and leave us a review. We'd love to hear from you.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.